Hello friends, now we will discuss the most important topic within accounting, that is financial statements analysis. Now when we talk about financial statement analysis, the first question that would come in our mind is why are we doing any kind of analysis on the financial statements? There's a very clear objective related to this analysis. We should be able to come to some kind of a conclusion that whether this company is good or bad from the point of view of investments. So this financial analysis actually helps us achieve that goal by letting us know how they have performed in the history and how they may be going to perform in the near future. So extremely important topic, and let us see how financial statement analysis is done professionally. So when we talk about professional approach, there are certain approaches which analysts do follow, starting with number one. There's something called horizontal analysis. Now what is horizontal analysis? Horizontal analysis is nothing but comparing 2 years and looking at their growth. So say for example, sales. If sales was maybe 100 in year 1 and it increased to 120 in year 2. So basically we are talking about a growth of 20 in absolute terms, or 20 divided by 100, which is 20% in percentage terms. So horizontal analysis actually looks at a line by line item within the income statement. So horizontal analysis can be done on COGS, taxes, or any item of your choice, profit after taxes and all. So what essentially we look at while we do horizontal analysis is that it helps us understand how this year was as compared to the previous year. So you can compare YOY, which is called as year over year kind of growth, or you can also have a QOQ, quarter over quarter kind of growth analysis can be done using horizontal analysis. So that's the first approach looked at by the professional analysts. Now after the horizontal analysis, there is the second term which is called as vertical analysis. Now there's a clear difference between horizontal analysis and vertical analysis. So if we are talking about horizontal analysis, we had actually assumed that we are comparing, let's say, 2007 with 2008, 2009. So we are comparing and moving horizontally. So you're moving horizontally, that's why it is called as horizontal analysis. Now what do we really understand by vertical analysis? So vertical analysis, let's say for example in 2007, a vertical analysis would actually mean we are going down. We are not moving across years, we're just going down. Now here there is an important term that we must understand, something called as a common size statement. When we talk about vertical analysis, we are essentially saying that we are talking about common size statements. Common size statements on the income statement, common size statement on the balance sheet can also be looked at. So what exactly is this common size statement? So let's kind of discuss this and see what it means. So let us now look at how common size statement can be made for the income statement. So if we look at the income statement format, it starts with sales, then we have the cost of goods sold, then we get the gross profits, finally we have the SG&A expense. So there are there are many expenses, and finally we come to the net income. So common size statement for an income statement would mean that we'll divide each and every line item which is mentioned here by sales. Now let's see an example. So say for example we had sales as 1000 and cost of goods sold as 500, so we get gross profit as 500, and in between also we had various other line items. Say for example net income is 50. So a common size statement for this year, so this was 2007, this would be 1000 divided by 1000. This would mean every line item should be divided by sales. So sales is divided by sales for the first case, and this is expressed in percentages. So this comes out to be 100%. Likewise COGS, 500 divided by 1000, this comes out to be 50%. Likewise, gross profit 500 divided by 1000, so it is again 50%. And we do this for all the line items in between and come to the net income, 50 divided by 1000, so this is 5%. So we do this for not only 2007, which is the first year, but maybe for other years as well, 2008, 9 and 10. So the primary reason for doing this vertical analysis is that we are able to identify certain trends, and these trends could be increase or decrease in gross profit margins, or maybe net income margins, or maybe costs may have increased or decreased. So we'll look at one of the examples to really understand how this works. But broadly speaking, it helps us in identifying the trends and also helps us in identifying certain issues within the income statement. Likewise, when we talk about vertical analysis for income statement, we can actually create a vertical analysis for the balance sheet as well. So what will be the balance sheet common size statement? Balance sheet common size statement would be divide each item by the total assets, which is the denominator, total assets. So say for example you divide cash item by total assets. So let's say cash was 10 and total assets was 200. This comes out to be 5%. So you do it for all these years and you divide each of the item by total assets, and when you have a percentage number for each and every item, we kind of look at an analysis and probably process this and see if we can identify certain trends, whether the cash as a percentage of total assets have increased over a period of time, or is that it has kind of decreased. So all these things are extremely important when we talk about looking at vertical analysis.